We just closed out a protected bond trade with Cliffs Resources. A successful trade. Return was 14% approximately over a 10-month period. The protected bond trade is one where we buy a bond at a big discount to its par value. And generally these are bonds that we wouldn't buy outright because we think that there's too much risk attached to them. But when we buy them with an insurance policy in the form of a put contract on the underlying shares of the company, we can mitigate the capital risk in buying the bond and still create an attractive yield. In the case of Cliffs, our yield, I believe, was approximately 12%. And as I said, due to fluctuations in the price of the bond, an improvement in the price of the bond, and somewhat of a decline in the value of our insurance policy because it became aged, we were able to lock in a 14% return over a 10-month period, which I think is approximately a 17% annualized rate of return. So these protected bond trades can be very interesting. That was kind of a middle-of-the-road example. I've done a video previously on one called Allied Nevada, where the company actually went into bankruptcy or reorganization, and we were getting a 9% yield in that position. But when the company went into bankruptcy, we got full value for our insurance contract, our put contract. We received a residual value for our bonds because the bonds are going to be part of the capital structure of the company once it's reorganized. We received some interest, in this case some currency benefit, and all in all that 9% running yield turned into a 40% or approximately 40% rate of return in the case of a failure of a company. So these transactions can be created to be lucrative in different environments. The most optimal situation is either that the company fails or that there's an extreme recovery in the price of the bonds. So in the case of Cliffs, I think we bought the bonds around 39 cents on the dollar. We exited at 51 cents on the dollar, and only 10 days later, the company had some fundamentally positive news, and had we held on to that position, we actually could have exited those bonds at 70 cents on the dollar, which would have been quite a higher return than we actually achieved, but nonetheless, hindsight.